firstly, we've got the risk disclaimer. I don't really need to say anything. If you've watched the other 19, 20 vids so far, then you know what to do at this point. Harmonic trading then, for some of us that have seen images like the ones you've got on the screen at the moment, it can be completely overwhelming and mind-blowing. However, the reason I wanted to do this section on harmonic pattern trading is the fact that they are very, very profitable patterns and can be worthwhile learning. So without further ado, before we get lost in figures, let's just have a brief introduction and a brief breakdown of why this all came about in the first place. So an introduction to harmonic trading then. Scott M. Carney, president and founder of HarmonicTrader.com, has defined a system of price recognition and Fibonacci measurement techniques that comprise the harmonic trading approach. There are various patterns that in this subsection we'll go through and break down so that you are fully aware of each pattern. We will show you how to draw them and confirm the pattern's validity, where to enter, where to trade, to set your stop loss and take profit levels for each individual pattern. We will use the main patterns as there have been many additions by other people since and many variations. So let's look back at why this started and how it will benefit us as traders to assist with our price action training. Let's step into the rabbit hole of harmonic patterns. Right then, where did it all start from? The roots of all harmonic trading started with the Gartley 222 pattern. It was so named as it was on page 222 of H.M. Gartley's book Profits in the Stock Market, published in 1935. Okay, so let's just look at that little bit before we move on. A book that was published in the 30s is still being worked on today. For me, that shows that harmonic patterns do have a place in the current market and they do clearly have longevity. There are many strategies out there that people use and tweak to death to the point where in the end they don't actually look like the original strat. And what I do like about this pattern is the fact that it's still going. Alright, now Gartley is the forerunner of the X to A, A to B, B to C, C to D, which we're going to break down even further, and that is the main point of how these patterns work. However, the Gartley is the one that started it all off. As time has passed, the popularity of this pattern grew and traders came up with their own variations on the same theme. This theme is to know and identify the market's pulse and rhythm and exploit those trading opportunities. This system provides us with visual occurrences that have a tendency to repeat themselves over and over again. Now, I've stressed this quite a lot of times when you're trading. Choose a pair or a stock or an instrument to trade that you get used to the movement of. Now, the reason we do that is it's not because it becomes a fluke, it's because it becomes second nature when you trade that instrument. And by that I mean you will know how that instrument works on a day-to-day basis. And I think that's why these patterns are so strong today, is that the fact that it works on Fibonacci extensions and retracements, all right, which we know are proven in the stock market and in the Forex market to completely repeat themselves over and over again. The market is of a fractal nature, and this means that patterns like movement repeat themselves over and over again, no matter what time frame or even the instrument that we're trading. However, I will add at this point, the larger the time frame, the stronger the pattern. Okay, I know some people out there still use 1 minute, 5 minute candles, etc. However, when I trade patterns, I look at 4 hour and 1 hour and I enter on the 15 minute, all right? And that's just my version of events. You may, obviously some people do it longer, where they look at weekly, daily and enter on the 4 hour. However, I strongly suggest that you look at larger time frames where these are a stronger entity. So like all patterns, the key is to identify the patterns early enough to enter or exit based on a high probability of the structure. Now, we all know that no strategy is 100% and patterns are exactly the same. They do not offer 100% accuracy. Some are stronger than others dependent on the instrument you're trading. This will come down with the knowledge through back testing and also forward testing on whichever pair or stock you are trading. However, if these patterns are identified, they are historically proven to give significant opportunities with very limited risk. For example, when we break these down even further, when I move into the pattern analysis, there is a pattern called the bat pattern. Now, you always place your stop below the start of that pattern movement, and by the mere nature of the bat pattern and its structure, that is a really tight stop. However, Gartley's have a bigger stop. However, they are proven, and I did read some time ago that I think Gartley's work 80 to 85% of the time. So even though you have a bigger stop initially, when the move starts, you then move your stop up to make it less of a risk. But obviously we'll break that further down when we start looking at patterns as individual patterns. We also need to know how to use Fibonacci extensions and retracements. Therefore, if you haven't used them for some time or you need to refresh, go back and familiarise yourselves with the earlier video on how to use these. And that can be MT4 or TradingView, because these patterns can be found on anything. All right. The reason I like these patterns, like I've banged on about a million times before, is the only true reflection of price action is price itself. And what I do like about, and probably why these are still so strong, 80 years after that book was written, is the fact that price is a really good indicator of what's happening. These patterns work off price action, and they work off Fibonacci, which we know are very strong in markets. All right, but we'll break down the solid ratios we need to know and be aware of before breaking down these patterns. And the reason I want to step up to this and show this is because a lot of fibs, especially MT4, don't have these extensions. So what I will do is show you how to, not now obviously, but once I've completed this, I will add another bit on there that shows you how to add these extensions onto MT4 so that you can use them. Harmonic ratios then, primary ratios that are directly derived from the Fibonacci number sequence, and these I'm sure you'll be more aware of, and that's the 0.618, which we know is a primary ratio, and we also know it's a retracement as it starts with a 0, and 1.618, which is a primary projection, which we all know is an extension because it starts with a 1. Anything greater than 0 point, so 1 above, is an extension. Anything less than 0 is a retracement, so smaller than. Primary derived ratios, I think you don't need to tie yourself up with the maths in this, but I think this shows why they are so strong, why the patterns are so strong. A 786 retracement, or a 0.786, is the square root of a 618. A 0.886 is the fourth of a root of a 618, or the square root of a 786. A 1.130 is the fourth of the root of a 1.618, or the square root of a 1.27, and a 1.27 is the square root of a 1618. So we can see just how strong these patterns are when they're bouncing between these extensions and retracements, because it literally is containing itself within that Fibonacci move. So every single time it hits from X to A, from A to B, from B to C, from C to D completion, you will see how strong that pattern then becomes, because it's literally bouncing off square roots of the original Fibonacci, okay, which we all know is super strong within any trading market. Harmonic patterns and what's known as the PRZ then. Harmonic patterns are defined by specific price structures quantified by Fibonacci calculations. These patterns represent price structures that contain combinations of distinct and consecutive Fibonacci retracements and projections. Basically a little bit like I've just touched on previously. If we calculate various Fibonacci aspects of a specific price structure, we can identify harmonic pattern areas that will hint for potential turning points in price action. Please listen to that part again. They hint for potential turning points. It's not a given. These patterns can repaint, they can extend, all right? So if one does start to run away from you, don't panic, all right? We're looking at a reversal zone. Scott M. Carney has identified these reversal spots as PRZs, the potential reversal zone. A well-defined PRZ usually provides some type of initial reaction on the first test of most harmonic patterns. The initial test can occur quickly, and on high volatility, it can immediately reject the price. Again, when I break down the patterns, I will go into this for you. However, all you need to know at this point is the PRZ. What I'll refer to when I do break down the patterns is the potential reversal zone. And that's it. That is it. That's the introduction over. What we're now going to do is move on and break each part down to each pattern so we can identify how the pattern works, where we need to measure it to, how to get in, where to set our take profits and where to set our stops. And I'm sure that is technically what you all want to know. I hope that helps. Thanks for your time.